It's a real pleasure to be back here, and I want to congratulate Anthony and the entire Skybridge team for putting on yet another successful conference. Before we get started, everyone has the biographies of our panelists here, but I wanted them to each take the opportunity to introduce themselves, perhaps with a fact that's not found in their written biography. So Leslie, would you like to start?
Sure. So I didn't join Goldman Sachs until I was 35, one of the only women on a trading floor of 70 men. And within 2 weeks, I developed a rash all over my arms and legs and went to the dermatologist and said, "Have you been hanging out in a men's locker room?" And so that was my intro to trading floors at Goldman Sachs.
Okay.
So funnily enough, actually, I joined the trading floor at Goldman Sachs as well, a couple of years after you, to a somewhat similar experience, actually. You know, the more things change, the more they stay the same. But in terms of something about me that people don't know, I'm actually Bulgarian. I went to school in Boston. I started my career in New York. I currently live in London. I'm married to an American from Orange County. Our permanent residence is actually in Miami, and my child somehow turned out to have a British passport, so he's British.
So where do you pay taxes?
What's that?
She doesn't pay taxes.
Oh, it doesn't pay taxes. Okay,
Yeah.
I just wanted to confirm. Okay.
Hi, Clayton DeGiacinto. Before I started a career in finance, I served in the U.S. Army, specifically stationed out in Hawaii in the 25th Infantry Division. I guess something interesting, I did go to airborne school and jumped out of a plane 7 times.
Good afternoon, everyone. Whenever I find myself in big open spaces, I'm always super excited. And the reason I say that is I spent 5 years on a Trident nuclear submarine in the United States Navy. So I don't hold the Army against you. But,
I get it.
But love big lights and big spaces after being on a submarine.
Thank you for that, and thank you for your service. Well, we'll just get started. Event-driven, as Laura described, is a label that has meant many different things over the last 20 years. It's been a name given for catalyst-driven investments, but that can include both hard and soft, deployed again across both credit and equities. So where do you guys see the most activity in that cross-section today? Mark, if you want to give it a crack.
Sure. You know, at its core, when you think about event-driven, we think about investing in any type of change that originates in the boardroom by the board, by the CEO. And you can almost think of sort of investing across 2 different dimensions. So one dimension being hard catalysts through soft catalysts. A hard catalyst might be a merger, a soft catalyst might be a management change, and the second dimension being both equities and credit. And for us, particularly being at BlackRock, where we own $3 trillion of equities, $2 trillion of credit, we could put that more holistic picture together to invest across that entire spectrum. Instead of being siloed in any one specific area, which is sort of much of the history of event-driven. And we think bringing together that more holistic picture across those different dimensions where the investor bases don't overlap can create significant value.
That's a very broad take on the phrase. Ivelina, I think you're a little bit more narrow.
Yeah, I mean, what I would say and what I would add to what Mark was saying is that obviously we have strategies, event-driven strategies, and obviously that is the mandate of the strategy. And then you have strategies which seek an event as a way of, number 1, shortening duration, and obviously number 2, in terms of generating alpha. So when we actually think about the type of instruments we deploy, we are very much agnostic to the type of instrument. Again, the one that will obviously help us get to the end goal, whether that's credit, whether that's equity, the one that is going to be most impactful in terms of an activist approach in case you're trying to manufacture an event versus you're trying to foresee an event, is the type of instrument we're going to be looking at. But I think that it's important to distinguish between an event-driven strategy and a strategy seeking events. And I definitely fall in the latter camp. Okay. And the reason that's important is because we are at a point in the cycle where I think events are actually incredibly important, because we all are aware that we are in a pretty mature credit cycle, and at some point in the future that will end. What you don't want to do is obviously be in a situation where you're completely dependent on the market to help you crystallize P&L. what you want to do is obviously be in a situation where you can affect your own fate.
Right.
And that is what this event-driven type of investment, these catalyst type of investments are allowing us to do, and are a way of distinguishing, again, between various strategies. So very important, and in my opinion, very topical, given where we are in the cycle.
Well, yeah, I mentioned, the past couple of decades. Has the growth in AUM towards this sector driven you guys to create these broader mandates, or why are they defined the way that they are? What's the genesis for how you're investing?
Yeah, I'll take that.
Yeah,
I mean, I
please.
think that the genesis is that folks are looking for things that aren't just pure market beta. And
You're not referring to any particular strategy, are you?
I'm
Oh, okay.
not anything specific. So the thing about event-driven is that whether or not the underlying event is an activist or a litigation or some other thing, it doesn't matter what's happening with the S&P. And so as the asset growth has continued, the niche or the bespoke element that's associated with event-driven gives some kind of buffer to the overall market beta, and I think that's what's driven the interest, not just AUM following.
Got it. Well, Clay, I want to get you in because you have a little bit of a different background than our other panelists. What has it been about the post-financial regulatory space that has made what you focus on, that's being structured credit, an attractive asset class? Because that same market period has been actually very difficult for fundamentally oriented long-short equity managers.
Sure. I'd point to a few things. Number one, there hasn't been a more re-regulated asset class than structured credit in the past 10 years. And there's a few cases of that we can point to. First, the CFPB have regulated what it means to be a qualified mortgage. It's had the either intended or unintended consequences of tightening lending standards nationally. Second, we've all heard Dodd-Frank and risk retention significantly limit what banks can both purchase as well as securitize and retain. And lastly, and probably most importantly, there's been a re-regulation of all banks and insurance companies as it pertains to their regulatory capital, where I think all the investors on this stage can think about economic return on capital. Our counterparts that run portfolios at insurance companies or even banks have to think about and are significantly constrained by return on regulatory capital, which is a huge edge for those investors in structured credit. I'd add that in addition to those three things, which makes this a systematically cheap asset class, it's also an asset class that's liquid but opaque in over-the-counter markets.
Yeah.
And that's an incredibly attractive sort of definition of an asset class to be involved in, if you're an allocator, in my opinion.
Do any of you agree?
Yeah, so we're also in the structured credit market and have about a third of our portfolio in it. And all the attributes that Clay mentioned are reasons why we also participate and invest in that market. And then it has the benefit of turning to cash. Readily, either through asset sales or aggressive amortization, that class is turning to cash on a very regular basis. So getting to the point about duration, and where we are in the cycle, it's helpful to have assets that you're not having to cross the bid-ask in order to have cash generation to redeploy as other asset classes become mispriced. And I think structured credit has the real attributes to that.
I think that's actually a very valid point. When we're actually thinking about liquidity, the reality of the situation is no matter how you cut it, liquidity in the system has been drastically reduced over the past 10 years. Yeah. So you need to create these natural events to take yourself out of risk as you're thinking about your portfolio, something that you didn't need to do 10 years ago, because guess what? The Deutsche Banks, the Goldman Sachses, the JP Morgans would be on the other side of that trade, taking you out of 100 million of risk. Right. This is something that simply doesn't happen these days.
Right, so liquidity drying up, regulatory regime change, certainly all factors over the last decade that have changed the market you're describing. Mark, you've been in it for that entire period at this, and so you've seen an evolution of sorts. How has the way that your investors have used you evolved during that same period? Has it correlated?
Yeah, I think the discussion has changed significantly over the last decade. I think when you broaden it to hedge funds and then event-driven within hedge funds, people have thought over the last 10 years, okay, hedge funds underperform or have underperformed on the way up and yet haven't protected on the downside. So I think the conversation also was muddled with alpha and beta being sort of put into one. I think now that people are starting to disaggregate alpha and beta, it really becomes an alpha discussion. And around that, I think there's two key questions that people ask. It's what's the outcomes that your type of fund specifically looks to get, so outcome-oriented solutions. And secondly, what's your competitive advantage? How do you achieve those outcomes in a way that nobody else can? And that's the question that we spend a lot of time looking to talk about. And I think for event-driven broadly, I think for our fund, the outcome that we look to provide is getting those events right and creating that idiosyncratic return orthogonal to markets, sectors, style factors, et cetera. And I think that's one of the exciting things about event-driven. These events don't correlate with much. And then secondly, from how does your team do it, or what's your competitive advantage? For us, it's at least being a thought leader as the top 5 shareholder for virtually every company on the planet.
Clay, you want to chime in on that?
I mean, I agree. I think in a market where we're at all-time highs on the equity market, last year we sort of know now that we can lose money in both fixed income and equities in the same year, which a lot of people maybe didn't think was quite true. I think structured credit is giving people, or at least I think how allocators are using us, is an alternative to a fixed income allocation, where we have a portfolio that liquidates about 2.5–3% a month. I agree, it's cash. We don't have to rely on the banks for liquidity, which is a very powerful dynamic. Q4, we had a portfolio that we could reinvest 2.5% every month in October, November, and December, and it has this sort of effect that we can buy or redeploy cash flows in a low duration manner because we're getting paid back at par in very stressed or distressed times. We're not trying to source liquidity at those times. We can actually be a liquidity provider at those times. So, it's in my opinion, it's tough to try to reach for return right now, and fixed income alternatives, sort of high single digits, consistent return is where people are putting us in their book.
So let's take a step back, because each of you have kind of alluded to the cycle. So where are we in this cycle? And for many years, people are predicting the end of the credit cycle. Do you expect distressed debt markets to pick up over the coming year? And if so, what's the magnitude of that opportunity? Yeah, go ahead.
Hopefully towards the end and towards the beginning,
okay.
Especially coming from a distressed perspective.
Sure.
No, I mean, listen, at the end of the day, I think we all know that we're in a very mature credit cycle.
Yeah.
Whether that's going to end in the next 6, 12, or 18 months, in my opinion, is going to be very, very difficult to tell. Primarily because, again, we have to think about the cycle on a global basis, and I actually think where the US is versus where Europe is versus where Asia is, while connected, they're just very different places. So if you could ask me this question, 18 months ago when we were thinking about the cycle, what I would have said is, hey, the US looks kind of wobbly, but you know what? Europe actually is about 18 to 24 months behind, so it actually has significant amount of time to run, etc. But what we are actually finding out, again, 18 months later, is that the roles are reversed. Actually, the US continues to actually show pretty solid economic data, whereas Europe is actually showing signs of slowing down, especially as far as manufacturing and PMI is concerned. And in my opinion, that is very much a function of the fact that as we historically look at cycles, Europe actually emerged from 2008-2009 episode without having actually resolved some big issues, i.e. banks actually never really purged balance sheets in a meaningful enough way. So what we're seeing right now is a little bit of a confluence between the current cycle and past structural problems which are coming to haunt Europe. So when we think about, hey, where are we in the cycle, we are in very different spots. Again, to a certain extent, extent, looking bottom up at balance sheets, looking bottom up, at structures across the globe, we are starting to see a little bit of a slowdown, especially as far as cyclical industries are concerned, and especially on the back of trade talks, simply because a lot of companies over the past 6 months have struggled to actually plan in terms of CapEx, and you're starting to see that flow through the numbers. But whether it's going to play out in the next 6, 12, or 18 months, very hard to say. What I can tell you, though, is that when the cycle turns, I think it is incredibly important for one to be ready to ultimately look at a bear market, deploy capital, because guess what? Unless you have a seat at the table and you're there with a fork and a knife, by the time that opportunity comes, you're not going to have a chance to eat because it goes back really fast.
Okay.
Yeah, and I think along those lines, when we ultimately do hit a more distressed credit cycle, I think that's a big question we get all the time, which is when is that going to happen and how are you guys positioned for it? And one of the things that I think people maybe miss right now is they compare it to the last cycle and say, okay, things are much better. And surely in the financial sort of regulatory markets, things are. But if you look at the corporate level, actually today you have 10 trillion of corporate debt outstanding versus 6 trillion back in 2007. You have covenant light on 80% of your credit versus 20% back in 2007. You have companies levered to 3.5 times net debt versus 1.5. So what does that mean? You sort of push all that forward. That means recoveries are going to be lower than they were in the last cycle. And I think we're going to have to just make sure we pick our spots because nothing's free in the world, right?
So we didn't learn our lesson is basically what you're saying. And along those lines, what do you guys think is going to be the next driver for when it comes, if not real estate? Do you guys have any views on that? And also if you want to chime in on what he was saying.
Yeah, no, I think it's just a different lesson, right?
Okay.
Because now where the debt is sitting is at the corporate level.
Right.
And so, again, you're in a obviously benign economic environment. And that solves a lot of problems. But if you look at what double Bs and triple Bs, to the stats that Mark just said, there's a significant amount of debt that's sitting there that a couple of exchanges or amendments on term or tenor are not going to fix. So I do think that it will, it'll be meaningful, and that it's a different world, and this time it will be faced without the liquidity of the large financial institutions. It's going to be private equity, the Apollos, BlackRocks, Blackstones of the world who are the ones with the deep pockets, and that will be a different dynamic as well, given where they sit at the table.
I would just add it's hard to argue that we're not late cycle in the corporate market, but the consumer balance sheet is the strongest it's ever been.
Right.
Consistent deleverage since 2010. Consumer debt to GDP is now at 80%. It was 100% in 2008. And an interesting statistic that I also just saw is debt service coverage. So individuals servicing their debt, it's basically now 10% of their discretionary spending. And that was 30% 10 years ago. So the consumer's in pretty good shape. Structured credit, I sort of want to change the name to structured cash flows versus structured credit because so many people, will lump us in with the cyclical nature of broader credit.
I wish, by the way, that consumer strength translated in retail sales because talking about corporates, there's a very big part of the economy that hasn't really heard about it to a certain extent, which brings me to where are we in the cycle. Guess what? We actually are seeing cycles unfold in front of our eyes as we speak. Like, nobody has told the oil and gas sector that they're not in distress. Nobody has told the retailers and the consumer discretionary guys out there that, we're not in distress. Same thing about TMT, same thing about healthcare. So actually, arguably, it is not just one big cycle, right? This big cycle is made of a lot of mini cycles that are actually very pronounced.
Within the industry, but also specific to certain geographies as well. So you can't make a general statement. Your point is that you are finding those opportunistic opportunities based on sector and geography, which is how you started your overall points today.
No, 100%, which is why you just cannot, paint everything with the same brush.
Do you think, though, as we talked about backstage, I was telling you, our business is very much based on the rise of investing in private markets pre-IPO. Do you think the fact that a lot of the liquidity now is going to be, as you started to talk about, on the private side, that will exasperate the situation when we actually do have this cycle turn?
The good thing about private debt is that very frequently private debt investing is done out of locked-up vehicles. Therefore, you actually have a match of assets and liabilities, right? So the good thing about it is even though 100% private markets have grown exponentially, and I think are going to be a big part of the story, investors actually have a significant amount of time to work through some of these issues. That is not the case with public markets. Again, very frequently you actually see, ETFs, mutual funds, etc., invested in capital structures which are dicey to say the least. I mean, triple C, in my opinion, is borderline distressed in many situations. So you saw it back in 2016, and I think we're going to see it again, right? When people have to sell, and you actually have this mismatch of liability, i.e. people have offered daily liquidity on these vehicles, and they're invested in something that is distressed. What happens is you have a print at 80, and then the next print is at 50, because there is nobody to take the other side of that trade as well. So I actually think that the rise of the private market actually is going to a certain extent, put even more pressure on public markets when the time comes, and it's going to exacerbate price moves, etc. But private markets are a huge part of the equation at the end of the day. We obviously think about the opportunity, and we say, hey, even at 4% default rate, that's 100 billion of pipeline. That's public markets only.
Right.
If you actually think about private markets, that's most probably 200 billion of pipeline. That's at 4% default rate. Obviously, if we get more to historical 7, 8%, etc., then actually the opportunity is pretty massive, just in terms of total breadth.
So, just to play a bit of devil's advocate, equity markets are at all-time highs, and you're an investor here, and you're like, you know what, why don't I just stay in passive long equities? Why should I complicate myself? These strategies are not that accessible to the average investor. Why is that the wrong thing to be thinking?
Sure, I'll answer. I think because the fact that the equity markets are richly valued, because the fact that the credit markets are richly valued is why event-driven is so exciting right now. It's when I talk, as an example, when I talk about mergers, I always get people say, you get so excited. And the reason I get so excited is, tell me one asset class that not only doesn't correlate with markets broadly, right? A merger, as an example, is governed by a contract, not the market. But these investments, because they're so idiosyncratic, they don't even correlate with one another. And I think sort of extend that broadly to event-driven. Take a year like last year, and our funds were up. Our Q4, we were up in Q4 against a backdrop of a down 13 market. Probably similar experiences across the board here. I think the biggest thing we hear today is we're seeing flows into our funds because people want to move away from direct equity exposure.
Yeah, I think that's why, because we are at all-time highs, and finding a place where you can redeploy capital and take advantage of distress. Again, when things go down, we've all been around. You don't want to sell. You've already lost. Can't create liquidity. Market keeps moving against you. So if you're in places where things are turning to cash, you're not feeling that mark-to-market shorter duration, then not only are you weathering that mark-to-market at the moment, but you're also able to deploy meaningful capital into a stressed time, which can have real multiple money returns.
To add to that, the only thing I would say, and I could not agree more, actually think that it is because the market is at recent highs and valuations are stretched that event-driven makes so much sense. But the only thing I wanted to add to that is, make no mistake, through the cycle, I personally would love nothing more than not be activists, buy bonds cheaply into capital structures that are ultimately going to be right-sized, or we can just grow into the capital structure. So we don't actually have to be incredibly hands-on to extract value, because let's be honest, extracting value requires a lot of
A lot of work.
CapEx, a lot of analyst time, a lot of PM time, a lot of headline risk. But we are simply not there in the cycle. I just cannot find, bonds to buy at 60 cents, believing that they're worth 95.
Well, on that note, though, can you guys talk a little bit about the way you source these opportunities? Because if you're going to say that you can't just sit back and look at these things as a monolith, it requires a lot of time, as you just pointed out, and effort. So for any of you, how do you differentiate yourself in the sourcing aspect of these ideas? For anyone.
Sure.
There's a lot to do in the structured credit markets, and one of the biggest asset classes in the world is U.S. housing stock. We are reading a lot about Freddie and Fannie and the potential privatization. Over the past 10 years, both Freddie and Fannie have done a pretty good job of, although they're retaining the economic, $7 trillion of mortgage risk that they're insuring, they've actually bought a very healthy amount of credit risk protection from the private markets. So it's private markets that's really pricing the credit risk for mortgages now. We have a partnership with Freddie on their small balance commercial program, where every loan that they originate on multifamily properties between $2 and $10 million, it's the government or it's the quasi-government, and we want them on the hook for that catastrophic risk, which is really the top 90% of the capital structure. But we can come in and buy that bottom 10% of the loan in a very well-diversified pool. We have, the bottom 10% of 3,500 mortgages out there, representing $8 billion of commercial real estate. There's going to be more of that. Those opportunities are readily available, and we get the luxury of sort of picking what's the best use of capital.
I think crowdedness is something that's been increasingly talked about, certainly over the last 5 years. When we think about us creating opportunities and how do we source, we're excited to be at BlackRock, where we are that top 5 shareholder. And you think about activists as an example and why they came about. Well, they came about because the large, long-only managers weren't engaging enough with companies.
Right.
And companies are desperate to get feedback. And so one of the ways we've been pretty successful in creating opportunities, and ones that are not broadly sourced by the market, is engaging with our companies directly to provide some I think, much wanted thought leadership.
Right.
And we're on the size, we're on obviously the other end of the spectrum. And I do think that one of the things that my partner and I have seen is that, as the big funds get bigger, their need for being in capital structures that are large enough for them to deploy a lot of capital. So from our sourcing perspective, it is either the small box in a complicated capital structure, which only has $425 million of debt outstanding, or a smaller capital structure overall. We find those to be, and while the AUM of the big guys is kind of admirable in many aspects, the idea of being able to kind of swim in waters that are not so crowded or niche has been meaningful for our returns.
I was actually going to make a similar point again. Like if you're, let's be honest about it. If you're not going to roll out of bed for anything below 150 million, the world feels small right now.
Right.
I don't think that's always going to be the case. I think that will change, but right this second, the world feels kind of small. You actually, I would argue, I don't even know if you can be in the business of buying bonds. I think you most probably need to be in the business of buying companies. If you're bite-sized though, if you're willing to look at situations where you can deploy 30 to 50, there is actually a lot going on. I mean, give you an example, right? In Europe, the average size of the European high-yield deal is 300 million. Now, imagine this trades down to 50 cents.
Yeah.
That means 150 million of debt. You need to buy the entire company to be involved if 150 is going to be your target size. So I think sizing is a very big part of the equation. But at the same time, again, what has been helpful to me as a strategy within CQS is, quite frankly, the breadth and the global nature of the platform.
Right.
The very fact that, like we have a loan business, we have a long-only business, we have bespoke mandates, we're involved in high yield, we're involved in structured credit, means that we touch a lot of parts of the market. So to a certain extent, again, we are engaged with sponsors, with companies, so that dialogue is very natural. It is significantly easier to obviously get involved in a situation that way, as opposed to, showing up and saying, hey, I have money, can you tell me about yourself?
Right. No.
So I think that the combination of those two things, there are opportunities out there. It is just that, PG&E does not happen every day.
Yeah. Well, I want to make sure everyone has an opportunity to also just talk about what they're most excited about, whether it's a particular name or trade or geography or theme that you want to convey to the audience before we end this session, because let's put a manifestation on some of the theories and philosophies you guys have espoused for anyone.
Sure, I'll start. We tend to be pretty idiosyncratic at the idea level, but I would say thematically, we are excited about and expect further consolidation in the healthcare chain.
Okay.
And I liken it back to almost telecom and tech back 20 years ago, where your TV was over the air, your phone was in your landline, your computer didn't talk to everything, and now it's all integrated via technology. Same thing is the case with healthcare today, where your pharmacist doesn't talk to your doctor, doesn't talk to your hospital, doesn't talk to the folks that do diagnostics on you. And we think that vertical integration going forward will change basically what today in the US you're this passive patient to really an engaged, active consumer of healthcare. And the transactions we saw last year, which we were very constructive on, so Cigna Express Scripts as an example, CVS Aetna as an example, we think that's just the beginning as the technology transformation of healthcare occurs over the next 5 years.
10 years ago, or I should say about 8 years ago, the government came out and wanted to force the hands of a lot of mortgage originators to forbear principal. They forbore about $15 billion of principal. That if you think about the legacy RMBS, residential mortgage-backed security landscape right now, it's about a $300 billion market. If we assume that 50% of this principal ultimately gets collected, there's upside capture of about $7.5 billion throughout the market right now. We like to focus through some technology efforts on deals or securitizations where we think there's more principal unaccounted for, and we think that's sort of upside that we don't have to pay for in bonds right now, and we're always looking for that.
In Europe, one of the more exciting things for me right now is Brexit, and the slew of possibilities and opportunities it might potentially bring. Quite frankly, regardless of which way it goes, because at the end of the day, companies ultimately need to act in a vacuum right now, simply because it's such a binary event. If for whatever reason we actually do have a real hard Brexit, I actually think that there will be a number of opportunities in real estate, consumer discretionary, dining, retail across the UK. So that's pretty exciting to us. The second thing I wanted to mention, just in terms of Asia, I actually think China onshore and having access to China onshore and being able to actually participate in the Chinese cycle is very, very important. The reason I keep on saying onshore is because, quite frankly, a lot of the lending is done in an offshore fashion, which can be very tricky because actually it is fairly easy for them to actually cut you off without any recourse. But I think China onshore in Asia is going to be very interesting. I think India is very, very interesting, especially, no pun intending, after they have restructured their restructuring system, and now we actually have a little bit of a process. And just in terms of industries, I know people don't want to hear it, but guess what? I do think oil and gas, if you can actually sustain the pain of owning some of these post-reorg equities, is most probably very cheap. You just need to have a multi-year outlook on the industry, and you need to have staying power.
I think more people want to hear about oil and gas than Brexit, but that's just me. So, please.
Sure. I mean, to be really specific about event-driven, since I would say ours is less thematic, it's very event-y. We're looking at things that, decisions in the Second Circuit Court as it relates to the Madoff estate being able to go after foreign fund of funds, whether or not Ohio is going to make a decision to support its nuclear assets, whether, when Vale and BHP will be able to get back to work in Samarco, which is obviously had a tailings dam incident. There's those types of very specific, idiosyncratic names that we spend a lot of time on and we find very interesting.
Well, if everyone could join me in thanking our illustrious panel for their time. Thank you so much. Appreciate it. Thank you.